Welcome to the Breakthrough Advisor Podcast. In this podcast, we inspire advisors with ideas and pathways to break through barriers and build a thriving retirement income business. We will interview innovative technology developers, business leaders, and successful advisors, then help you organize and execute these ideas to move your business forward.
Hello, folks. Welcome to the Breakthrough Advisor Podcast. This is Jack Martin. I serve as the virtual CMO for InsureMark. I want to welcome you to this episode of the podcast. We've got Ed Slott on. Many of you know him. He's America's IRA expert. We couldn't be more excited to have him here. This podcast is designed to help you take your practice to the next level, and certainly Ed is one of the best people to help us do that here in this moment with respect to taxes and inflation. Good morning. How are you doing, Ed?
Great to be back with you, Jack.
Thank you very much. Hey, I wanted to talk to you about something you wrote talking about this 3-year window that we have to capitalize on inflation and taxes. Any way to capitalize inflation, I think, is going to get our advisors' attention. So how do we go about doing that? And what's this 3-year window about?
Well, inflation is usually bad. I mean, everything costs more. Everybody's been screaming about inflation the last year. But when it comes to taxes, it's great. Like that cereal, it's great. Why? Because tax brackets expand when there's inflation. And we just had the greatest expansion because the inflation factors, these cost of living indexes went up so much from 2022 to 2023. It expanded the brackets, not the rates. The tax rates are the same, but more income can be pushed through at these low brackets, the 12, 24%. I'm looking at some of the brackets now, 30. For example, in the 24% bracket for married couple filing joint, you can push up to $364,000 of income at that low rate. We've never seen anything like this before. So this is a great opportunity for get rid of some of that future taxable IRA, a 401k. Remember, these accounts that most of your clients have are loaded with taxes. They think, here's a good one, they think it's their money. Not till you can only keep what you keep after taxes. I'm worried about future higher taxes leaving people with less of their money. And the Secure Act, and now Secure 2.0, made that even more of a reality by killing the stretch IRA, mainly on the beneficiary side. But these are your future clients. And Secure 2.0, they've downgraded IRAs as a wealth transfer or estate planning vehicle. So you need alternatives. This is great to talk to clients about. So here's what I mean about the 3-year window. These historic low tax rates are going to continue only for 3 years. This year, 2023, a great expansion of the brackets. It's going to happen again next year. We don't know what next year's inflation factor is, but it's always something. So they'll be expanded a little more. And again in 25. After 25, assuming the law stays as it's planned to, you never know with Congress, they always have something up their sleeve, especially when they need money. The rates are supposed to go back to those higher rates back years ago after that Tax Cuts and Jobs Act. Will it happen? Well, it's supposed to happen. We know what the rates will be, and these brackets will be for at least 3 years. So why do I say there's a 3-year plan? Well, I'm worried, and you should be if you have clients, and the clients you should be talking to are the clients, probably your best clients, the ones with the largest IRAs or 401ks, because it's more likely more of those balances will not be spent by the clients and will be transferred at death to their beneficiaries who have this short 10-year window now, a short 10-year window to push all the income out. Not only that, these beneficiaries, I'm not talking about kids, most of them might be in their 50s or 60s, might be in their own highest earnings years. And remember, why do you care about beneficiaries? Well, you should. These are your future clients. This is the succession plan for your business. And you should be connecting with these people and let them know the benefits you can provide, maybe over 3 years, with alternative solutions, getting rid of this IRA money while you can get it out on sale. Taxes are on sale. The difference between this kind of sale, a tax sale, and the sales you and your family may be used to, when you see all these ads, everything's on sale. Well, that's good when the stores have a sale. But here's the thing about the store sale. The things in the store, sorry to say, you don't actually have to buy them. But with taxes, you do. There is no choice. So with taxes, yeah, if you can get it on sale, get it now. The foundational principle of all good tax planning is to always pay taxes when the rates are the lowest. Remember, the taxes on these heavy accounts, the IRAs and 401ks, are going to increase. I believe at some point they have to be paid. It's not if, but when. And if you can get those funds out on sale, you'll be doing your client a big service. Yes, they may have to pay some tax up front, but if they can get it out at low rates, they will almost always end up with more and more tax-free later on if they move those funds to tax-free vehicles like Roth IRAs and especially life insurance. Yes, it's true that Congress put the kibosh on the stretch IRA and gave us the 10-year rule, but indirectly, they shot themselves in the foot. Now, all they did is incentivize all of us to talk to clients and beneficiaries about the planning we probably should have been doing all along. All along, Jack, the IRAs were a complicated asset to get to the next generation. But now we have an alternative. It's best for beneficiaries to inherit tax-free life insurance. First of all, the leveraged wealth transfer. They get larger inheritances. Clients can have more control and less tax. And Roth IRAs, similar. Anytime you move to tax-free vehicles, yes, there's a cost up front. That's exactly what I'm saying. That's where people miss the boat because they think short term. In fact, when I mention this to consumers, Jack, there's always somebody that says, I talk about Roth IRAs and life insurance. They say, but why would I pay a tax up front when I don't have to? I said, you're thinking short term. You want a plan that lasts a lifetime, not a lunchtime. You need, something long term. This is the opportunity of a lifetime for advisors to show their value by start creating real value, building balances tax-free as a hedge against what I believe at some point will be future higher tax rates unless Congress keeps kicking the can down the road. But look at the debt levels, $31 trillion. I don't know how. Can you imagine, Jack, if a business ran like this? So you go in to the restaurant, let's say, you spend money, yeah, and then you have a vote on with your family around the table if we want to pay the bill or not. That's how Congress works. The whole system's like on a dine and dash philosophy. I mean, that's what they do. They want to vote on when we'll pay, if we decide to pay the bill. Your clients don't have that option. That bill's coming due on the taxes, so you want to help them. Your big master plan is to help them keep more of their hard-earned money by moving more of it to tax-free vehicles when tax rates are low. And that, to me, with the tax rates low because of the inflation factors, is the planets are all aligned. It's a great opportunity for you to have conversations with your clients and let them know the plans they have currently, the clients, probably won't work as intended. Maybe they haven't been spoken to since before the Secure Act, and they still think they're getting a stretch IRA, or they think their IRA trust will still work. It won't. That's why they need you.
Ed, that was an amazing amount of wisdom you just dropped in that few minutes.
Jack,
thank you very much.
Say that listening to me is like drinking from a fire hose. You just have to start me up.
Exactly. Wind you up and hit the go button. All right. So what I heard you saying is inflation is good for tax planning.
Yeah.
I heard you say that the current tax rates are going to sunset unless Congress votes to lower taxes again. And we all have to say that's not likely. Right? Not in the world we're living in today.
I think it's more, when I ask clients about this, I do lots of consumer seminars. Matter of fact, I was talking to a group yesterday, and I always ask them, do you think you'll be in a higher bracket in retirement? And only half the people raised their hands because And this is what you have to get across to clients, because they all believe, and this is a big myth, they will be in a lower bracket in retirement because they think logically. But when it comes to taxes, you can't use logic. Here's the logic. They figure, well, I'm not working anymore. I don't have my paycheck, my self-employment. Of course, I'll be in a lower bracket. As we all know, as advisors, that never happens. In fact, I remember a client coming to me years ago when I was doing more tax returns, and it was the tax return for the first year in full retirement. And he's looking at me, he says, how can this be? My income's higher than my greatest working years. I said, that's because you never listen to me. I told you about Roth conversions for years, but you didn't want to pay the tax up front. Now you got this large IRA, and your RMDs, that's your income, are higher than your best W-2 ever. Plus, so your income's higher. Plus, you don't have the deductions and the tax benefits that you used to have. You don't have deductions for 401ks anymore. You don't have any tax benefits for dependent children. You paid off your home. You don't have any mortgage interest deductions. State and local taxes are limited. So really, you have higher income and less deductions. And that's why most retirees end up in a higher bracket, even though they don't think it's possible. That's the message you have to get across. By helping them now, they can truly be in a lower bracket in retirement. Matter of fact, if they move more to tax-free vehicles, they don't have to worry about the bracket because it's zero.
Good point. And so you triggered a thought that I've been percolating on. So the Secure Act 2.0 talks about pushing the RMD starting date out, and we can talk a little bit about that in a second. But really, that compounds the problem, right? Because most people don't want to take money out of their IRAs to start with unless they're forced to. Now they're not going to be forced to sooner. It's going to be later, and so they're going to have larger and larger IRAs, which means those RMDs in the out years are going to be bigger and bigger. So where's the beef in this Secure Act 2.0?
The beef is, first of all, there's not a lot of beef. It's not earth-shattering. You know, the original Secure Act upended all the plans for most people with IRAs. It was transformative. It was a game changer. I mean, it took away their plans for stretch IRA kids and grandkids, gave us this complicated 10-year rule. Secure 2.0 was hyped like that, but it was none of that. It was not a game changer. They trimmed around the edges. They opened up more avenues for Roth IRAs, which I love, and a bunch of other provisions, over 90 retirement provisions, but nothing earth-shattering. But this one, the one you cite, exactly for the reasons you said, where they raised the RMD age, yes, the good part about it is now your clients have more freedom to do things for another year. It was 72. And don't believe the stories about the RMD age going up to 75. Yes, that's in the law, but that doesn't happen for 10 years. So I've seen that in the headlines, RMD age going to 75. Yeah, when you're dead. That's not going to happen for 10 years. So moving it up a year gives people more freedom to do the kind of planning we're talking about. But the problem is exactly as you said it. You said it better than me. You know, if not for the last minute, nothing would ever get done. You know, people say, oh, great, I can put it off. But every year, every minute you put off the planning we're talking about, taking money out of retirement, you're shortening the window because there's an end date now. Remember, before the Secure Act, the end date could have been 20, 30, 50, 80 years with the stretch IRA, no more. Now the end date is a hard 10 years after death. So let's say, for just to go to make an extreme example, what if they raise the RMD age to 90? Well, most people might be dead by then. So you're really shortening the window, and all that income has to come in a short window. Beneficiaries are going to lose a ton of money in taxes, and these are your future clients. So it's good that you have more freedom to do things, better planning before RMDs begin, but you have to almost re-educate clients to say, no, don't do that. Start a plan to expand the window, get more out over a longer period of time, taking advantage of these low brackets we have now.
You make a great point. And so just in closing, I know you do a lot of consumer facing events. And so what are you hearing from consumers about taxes and about their advisors?
Well, first of all, we live in a very polarized country. So you get a room of consumers But when I talk about taxes and saving on taxes, everybody's with me. There's no politics in that room. Everybody likes to save on taxes and keep more of their hard-earned money. And remember, the people that show up have significant accounts they want to preserve. And, whatever they say about their kids, oh, I can't stand my kids, they still want to leave them larger inheritances with less tax and more control. So that everybody's in agreement on. But one thing I found when I've been talking to people about alternatives, like we're talking here, and I mentioned things like Roth IRAs, and in particular, life insurance. Again, I don't sell it. In case people don't know, I'm a CPA, a tax advisor. I don't sell stocks, bonds, funds, insurance, annuities, but I always show life insurance, which I think has been moved up to the top of the list as the best alternative to what Congress did by forcing all this IRA money out in a short window, is to get that money out and get it to put it in life insurance, pay some tax. I'm always talking about paying tax now, but if you're paying at low rates, you've got the deal of the century, because this money will be taxed. And then I start to see the heads nod. They say, I like that idea, tax-free windfall, but in particular, I focus on a permanent cash value life insurance where it can build cash value. They like that idea because I'll tell you why, and this is the secret. Never talk about the death benefits. They don't care about that. They say they care about their kids, but they don't. They don't care about that. They care about what's in it for me. So I focus on the lifetime benefits, the fact that you can build cash value and have access to that tax-free if you need it during your lifetime. And again, like a Roth IRA, it's a hedge against what future higher tax rates can do to your standard of living in retirement. And if you don't need it, then yes, the kids will get a tax-free windfall. But you don't have to deal with all these complicated IRA tax rules. It's more complicated than ever. Congress has made this a lousy asset, but on the same time, they may have downgraded IRAs as a planning vehicle, which Congress they said they wanted to do. And they upgraded life insurance, permanent life insurance, as probably the number one solution. And more people are coming around to that.
Awesome. Ed, this has been amazing as usual. Thank you very much. I think we're all going to go back and listen to this a couple of times to get all the wisdom out of it. On behalf of InsureMark, this is the Breakthrough Advisor podcast. We want to thank Ed Slott. We want to thank you for listening to us. Feel free to like, share, comment. You can find the podcast wherever you get your podcasts, whether it's Apple, Spotify, Blueberry, any of those are available to you. Thank you very much for joining us today. Ed, thank you very much. Look forward to seeing you again next time.
Thank you for listening to the Breakthrough Advisor podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of InsureMark. The content has been made available for informational and educational purposes only.